Straight-run PSUs are known to maintain a steady dividend record, especially so in the oil and gas space, be it ONGC or the fuel retailers like HPCL, BPCL and IOC. But Moody's Investor Service says that trend may well be detrimental to their credit ratings. More so for the oil marketeers who are otherwise expected to post healthy numbers in the fourth quarter. Joining us now from Singapore is Vikas Halan, Senior Vice President in the Corporate Finance Group at Moody's Investor Service, to explain why. Thanks very much for joining in, Vikas. Let's get in a sense from you as to what exactly are you witnessing as a bigger threat to the dividends that most of these oil marketing companies are paying out in terms of their overall quarter four numbers, and how that will be effective on that.
Yeah, thanks, Davina, for having me. The oil marketing companies have not been paying steady dividends. This is a very recent trend. ONGC Oil India, yes, there was a steady dividend, but ever since the DPAM guidelines came out, the dividends almost tripled by oil marketing companies. And this is something that has been putting pressure on these oil marketing companies. Let's not forget they've also spent money on acquisitions, which has resulted in increase in borrowings. Now, on the Q4, which is January to March quarter, what we have seen is the refining margin in the region have basically dropped to one of the lowest that I have seen. So the average for January to March, the refining margin, at least in the region, was $3 or so, and that was saved by a recovery in March. So we don't expect the numbers to be great in January to March, especially if you exclude inventory gains. Yes, there would be inventory gains which could help them, because in October to December quarter, there was a huge inventory loss. So there would be some bit of recovery because of that. But underlying refining margins were really bad in January to March quarter. And therefore, what we expect is if the refiners continue to pay dividends, and more importantly, because they have done share buyback, particularly Indian Oil Corporation, the big share buyback they did in January, is putting some pressure on their credit metrics. And although the upstream companies were able to afford it because oil prices were going up, the downstream companies, the refining margins went down, and therefore we think it's going to put pressure on their credit metrics. And that is where we come with a divergence in the view that it is affordable for the upstream companies because of high oil prices, and let's not forget no subsidy burden or no additional tax. And it is not as well positioned for the downstream companies because of lower margins and also lower petrochemical spreads.
But compared to the previous quarter, when crude oil was at heady levels of about 86, we're still not at those levels. We're still close to about 70. So how does that weigh in terms of the difference between the two quarters, quarter three and quarter four?
So if you look at the average oil prices, even for the last quarter, it wasn't that high. The average for this quarter is also not significantly different. But what is different is the quarter end prices. So between the beginning of the quarter, in the last quarter, October to December, as you rightly pointed out, the crude was closer to 80, but by the end of the quarter, it was more closer to 50. So there was a huge inventory loss that they had to book. But in this quarter, when we started off with closer to 50, we are ending closer to 70. So you are going to recover in terms of the inventory losses as such, because they take into account at the quarter end prices. Whereas for the upstream companies, the average prices matter more, and therefore we think the earnings improvement that we saw for the upstream companies will continue to be sustained. The earnings will be sustained, but the growth may not be there.
You also talk about constraints to credit profiles because aggregate borrowings might go up for most of these oil marketing companies, and even the likes of an ONGC, if they have to maintain that steady dividend payout that they look at.
Not so much for the upstream companies, but more so for the downstream companies. And there are a couple of reasons that differentiates the upstream versus the downstream here. Now, the downstream companies, even though the subsidies have been taken out, there's still DBTL, which actually has to go from the oil marketing companies first, and then they ask for reimbursement from the government. So this reimbursement has been getting delayed and delayed. So previously it used to get reimbursed within a month or so. Now I think it's taking closer to 6 months. And that is why the working capital increases for the downstream companies. So in addition to payment of dividend and share buyback, you are now doing a delay in subsidy reimbursement because the government has its own fiscal maths to think about. So there is a increase in borrowing structurally because of that. This is almost going back to the pre-2014 days, not to that extent because the subsidy amount was huge. Here the subsidy amount is lower, but it all adds up because the dividend has gone up, share buyback is being done, you're spending in capacity expansions, and then you also have to bear the subsidy working capital increase. So all of this adds up to the increase in borrowings. Things are not looking as bad yet, but if margins go down further from where we are, and so that results in earnings decline, cash flow decline, and they continue to maintain this high level of dividend, then we have an issue. But at the moment, things are still just about fine and within the rating tolerance level. What we are saying is if this continues, then we may have an issue with the credit quality of these companies.
And you say that IOC is better positioned than BPCL within the credit matrices.
That is correct. Even though IOC has done share buyback, even though IOC has increased or paid interim dividend, and BPCL has reduced its interim dividend, IOCL started off with a lower leverage than BPCL. BPCL was already closer to debt to EBITDA of 3 times, whereas IOCL was around 2 times. So even though IOCL's leverage will increase, it will still be below 3 times, and BPCL's leverage will increase above 3 times, which is where we draw the line in terms of our tolerance. So that is where we think if they continue on the path that they are, there is a risk of them breaching the downgrade trigger. BPCL would be the first if they continue with their dividend policy. And then if IOCL continues also, they will go down that route.
Let's talk about, pricing of fuel pre-elections and what happens if at all. There is a case where most of these oil marketing companies are probably told not to take price revisions ahead of elections, and how that works out.
Yeah, it's interesting. So, the election period is about 40 days. And, let's say you start price freeze 10 days before that. So you're talking close to about 50 days. And within that 50 days, the total consumption of petrol and diesel, the prices of which may be frozen, is close to 130 million barrels or so in India equivalent. Now, if you take $1 price absorption during that period, $1 per barrel, you're talking about a total of $130 million of distributed between the 3 companies. So I don't think it's going to have such a big impact if there is not a price increase or decrease in the market, or the price increase decrease in the market during these 50 days is close to a dollar per barrel. But it is seldom $1 per barrel. When you look at the volatility, it could be $10 per barrel. If that were to happen, yes, there could be an issue. But to expect a sustained increase in price of $10 over 50 days, that's not something that we are expecting at the moment. I mean, let's not forget the gasoline spreads are close to an all-time low because of high inventories. Yes, there has been a recent improvement in the gasoline. The rupee has appreciated significantly, which also plays into the math of the pricing at the retail stations. And you've got crude oil, which is already at close to 70. So is there a further significant uptick from here in the prices? Unlikely. But if that were to happen to the extent of $5 to $6, you're looking at overall 500 to 750 million if the worst case scenario really happens. But the other side of the equation is that if actually prices fall, would you be recovering those losses? And what we have seen in the past is, yes, if the prices actually fall, they recover the losses. So over a 50-day period, it could go one way and then come back the other. And overall, you may not end up losing anything. And even if you lose something, the continuity of a government coming back to the power that could allow you to recover those losses post-election. So if you look at it over a longer period, then it is unlikely that this particular thing will have an impact unless the price volatility are very, very significant. So yes, there is a risk, but I think the impact might not be very significant.
Got that. Vikas, it was great chatting with you and getting your insights. Thank you so very much for joining us on Bloomberg Wind this morning.